The Gold Standard of Modern Investing, a comprehensive guide to Vanguard S&P 500 ETF, VOO. As of January 26, 2026, the Vanguard S&P 500 ETF, ticker VOO, remains the bedrock of millions of retirement portfolios worldwide. Often referred to as a core holding, VOO offers a straightforward, low-cost way to own a piece of the 500 largest publicly traded companies in the United States. For an investor in early 2026, VOO represents the ultimate set-it-and-forget-it strategy. While 2025 was a year of massive growth for the S&P 500, fueled largely by the continued expansion of artificial intelligence and a resilient U.S. consumer, the start of 2026 has brought its own set of questions regarding market concentration and high valuations. This guide explores the mechanics of VOO, the magnificent weightings of its holdings, and the essential risks you must understand before committing your capital. 1. What is VOO? The foundation of passive investing. To understand VOO, you must first understand the S&P 500 index. This index is a list of approximately 500 of the leading companies in leading industries of the U.S. economy. It is widely regarded as the best single gauge of large-cap U.S. equities. The mechanics of an ETF. Passive management. Unlike an active fund where a manager tries to pick winners, VOO is passively managed. Its only job is to mirror the S&P 500 as closely as possible. If a company joins the index, VOO buys it. If a company leaves, VOO sells it. Exchange traded. VOO trades on an exchange just like a stock. You can buy or sell shares throughout the trading day at the current market price. Full replication. Vanguard uses a full replication strategy, meaning it holds every single stock in the index at the exact same weighting. 2. The 2026 snapshot. Performance and holdings. Entering late January 2026, VOO is trading near all-time highs, reflecting a market that has largely shrugged off previous fears of a recession. Key statistics. As of January 26, 2026, market price, around $633.83, up from roughly $450 a year ago. Expense ratio, 0.03%. This is one of the lowest in the industry. For every $10,000 you invest, you pay only $3 per year in management fees. Dividend yield, 1.14%. While not a high-yield play, VOO distributes the dividends it collects from its 500 underlying companies on a quarterly basis. Net assets. The fund has surged to over $1.4 trillion, underscoring its status as one of the most liquid and trusted investment vehicles on the planet. The top-heavy reality. In 2026, VOO is more concentrated than ever. The top 10 holdings now account for nearly 33% of the entire fund. These include Nvidia, around 7.7%, Apple, around 6.9%, Microsoft, around 6.1%, Amazon, around 3.8%, Alphabet, Google, around 3.1%, Meta, Facebook, around 2.5%, Tesla, around 2.1%. Investing in VOO today is, to a large extent, a bet on the continued dominance of American big tech. 3. Why VOO is the simpler path to 1 million. The primary appeal of VOO is its historical track record. Over the last century, the S&P 500 has delivered an average annualized total return of approximately 10.5%. The power of compounding. If you were to invest $500 a month into VOO and it maintained its historical average, you could potentially reach a $1 million portfolio in roughly 30 years. The advantage of low fees. Because VOO only charges 0.03%, almost 100% of your returns stay in your pocket. Over 30 years, a high-fee fund, charging 1% or more, could cost you hundreds of thousands of dollars in lost compounding potential. Outperforming the pros. Historically, about 85 to 90% of professional fund managers fail to beat the S&P 500 over a 10-year period, after accounting for their high fees. By buying VOO, you are effectively beating most of Wall Street's elite by simply matching the market. 4. The 2026 risks. What could go wrong? While VOO is often called safe, it is important to remember that it is a 100% equity fund. It can and will fluctuate. 1. Valuation risk. As of January 2026, the S&P 500 is trading at a price-to-earnings ratio of roughly 29.5x. Historically, the average is closer to 16x. This means investors are paying a high premium for every dollar of corporate earnings. If earnings growth slows down, the market could see a significant reset to align with historical norms. 2. Concentration risk. Because VOO is market cap weighted, the largest companies have the biggest impact. If the tech sector experiences a dot-com-style bubble burst, VOO will be hit much harder than a diversified equal-weight fund. In early 2026, some investors are moving a portion of their capital into the Invesco S&P 500 Equal Weight ETF, RSP, to mitigate this specific risk. 3. No small cap exposure. VOO only tracks the 500 largest companies. It completely misses out on small and mid-sized companies that might be the next big thing. Many 2026 investors supplement VOO with Vanguard's Total Stock Market ETF, VTI, to capture the entire U.S. market, or VXUS for international exposure. 4. Sequence of returns risk. If you need your money in the next 2 to 3 years, for a house down payment or retirement, VOO is risky. A 20% bear market can happen at any time, and if it happens right when you need to sell, you may be forced to take a loss. 5. Investment strategy. The VOO and chill method. For the average person, the most successful way to invest in VOO is through dollar cost averaging, DCA. Don't time the market. In 2026, with the market at all-time highs, many are tempted to wait for a dip. However, history shows that time in the market is more important than timing the market. Automate your plan. Set up a recurring buy every month. By investing a fixed amount regardless of whether the price is $630 or $580, you naturally buy more shares when they are on sale and fewer when they are expensive. The long-term horizon. VOO is designed for a 10-plus year timeframe. Short-term volatility is noise. Long-term corporate growth is the signal. Conclusion. The core of a modern portfolio. Vanguard S&P 500 ETF, VOO, remains the most efficient, transparent, and cost-effective way to participate in the growth of the American economy. While its heavy tech concentration in 2026 requires a watchful eye, its track record of survivability and wealth generation is unparalleled. The verdict: if you are looking for a foundational investment that balances high growth potential with institutional-grade stability, VOO is the standard. It is not a get-rich-quick scheme, but a get-wealthy-slowly machine that relies on the two most powerful forces in finance: time and the compounding growth of America's greatest companies.